Let's take the conversation forward. Taher, good to have you back. Thank you for joining us. Taher, we've got a report coming from Credit Suisse, and they are making a case that yes, India has done a great. It's been an exceptionally strong year for us, and we are amongst the top outperforming market in the emerging market basket. But they are now making a case that it's time to be careful, because even if earnings are strong, the valuations in a sense do not support the risk reward ratio. What is your sense? We may be in middle of a good earnings season, companies may outperform, but do you think markets are factoring that in?
I think that at least the next some quarters or few months we will contend with this issue that markets have had a very strong rally, almost a one-way rally, and valuations are where they are. They are certainly not cheap. There are some pockets of the market which are a little frothy, while at the same time there are also certain parts of the market which are not very elevated either. So there is a certain amount of balance in the market, but I would like to think that we probably had a relatively smoother ride. There are certain risks which are kind of lurking in the sidelines, and right now they may not necessarily be very prominent, but we need to be careful about those. And some of these risks can unfold over the next 6 months' time, whether it is with respect to the central bank action, particularly with regard to their stimulus unwind or stimulus deceleration, or whether it could be commodity prices for another, inflation trends, even vaccination trends as far as locally India is concerned. So some of these things are kind of lurking on the sidelines, and we need to see how they kind of unfold. And some of these things perhaps may have the ability to impact the market somewhat, if not significantly. So I'd agree that we are a little stretched in the very near term, but I think on the more medium to long term, I think we probably still have enough levers to grow. So I guess we should be reasonably fine. Overall valuations are high, but they're not of the type which really makes you run away from the market. So I think we are in a somewhat balanced zone at this stage, with a certain amount of eye on the risks which potentially can unfold.
Taher, I tweeted on Friday, and I said the historical benchmarks for bull market are high retail participation and a lot of action in the IPO market. But this time I genuinely feel it's different, and that's my personal view, which is that retail participation is a function of change in asset allocation, and IPO excitement is a function of change in terms of the historical timeline and the cycle of IPO market. And this time it is different. A lot of people disagreed with me. They said there's nothing called different. These two indicators are indicating that markets are about to peak out. Let me hear your thoughts.
I think, I hope these are not the famous last words, quote unquote, but so yes, we've got some of these telltale signs that we need to be careful about, but we have to put all these telltale signs of the historic past in the current context, and then make your decisions. So I think there is enough retail participation which is going around, but we are still underowned as far as equities as an asset class is concerned. So that has not really gone up as much as, let's say, the intensity of increasing demat accounts, etc., seem to suggest. So there is a certain amount of, let's say, short-term trading-related activity wherein where the market is probably a little more concentrated. The second thing is that IPOs, probably if you were to use that as a barometer, we need to differentiate once again the kind of IPOs which are coming in today versus what probably used to come in 5 years or maybe even 10 years ago post or around the GFC. I think the nature of the businesses are different. They are relatively asset-light models. And therefore, we probably have a certain different set of risks. So I'm not trying to say that everything is hunky-dory. The circumstances are different. The overall scenario backdrop of the economy and the way tech is evolving around us and digital opportunities are evolving around us is something that we need to put in context. But yes, from the point of view of valuations of some of these IPOs which are in there, they're clearly for the long haul, and therefore you need to kind of make your investment horizon significantly long in order to be able to kind of make some money out of these. Maybe you may not lose as much as perhaps you did in case of asset-heavy businesses in the past cycle of IPOs, But nonetheless, I mean, basic principle of investing still need to be adhered to. So I think there are certain similarities, there are certain differences. We need to weigh one against the other.
Sure. That is getting a little bifurcated within sectors as well. And, what started off with stock prices is now spelling out in earnings. And clearly the markets were right in predicting so. I want to first pick up IT because that's where a large chunk of earnings are already out. What TCS did wasn't replicated by an Infosys and HCL Technologies was a complete contrast. How is it that you are now navigating amongst the entire IT pack? And is there a higher tilt towards mid-cap IT? Because that's where a large chunk of the earnings traction is actually taking place.
Well, I think the way we are cutting the IT pie is more on the basis of not as much perhaps on large cap, mid cap, but probably more on the basis of services versus probably typical IT services versus, let's say, more specialized ER&D services, if you may will. And that's how we are kind of differentiating some, because the runway to growth perhaps, or the kind of market size which is available to some of these companies in the ER&D space versus typical IT services could probably be a little different, and therefore the more CAGR growth oriented prospects could be a little higher compared to traditional IT services. But having said that, even currently as we speak, there's a very strong tailwind behind even traditional IT services, and I think we are seeing that across the board as far as top lines of most IT companies are concerned. Give or take, they are all extremely robust, and they're looking forward to even better quarters given the kind of pipeline that they are having with them. So I think that's something which is quite enthusing, and that will hold up the valuations of many of these IT companies, even in the traditional IT services segment. Of course, along with which now gradually, as you know, risks on costs are starting to emerge as well. So we have to be careful, particularly with regard to attrition rates and how the employee pyramid is managed and how employee costs are managed. So I think what we are playing for, at least as far as IT companies is concerned, is essentially bottom line growth, which is probably going to mimic more of top line growth over a period of time. We are probably not at this stage playing as much for either the operating leverage or the margin expansion upside, and nor are we probably playing them for value anymore. I mean, we had a decent number of IT stocks that we were playing for the value proposition maybe about 6 months ago, let's say towards the second half of last year. But I think that's probably not as much the proposition on the table right now. So it's essentially growth at a reasonable price, or maybe a little more of a price. So that's how we are kind of cutting it in our minds. More of the division between traditional versus somewhat something which is a little more specialized. And then we are kind of equating some of the tech platforms also along with them. So it's a mix between IT services platforms and ER&D services, if you wish.
Sure. What is it that you're making of the banking earnings so far, Taher? Because what one gets a feeling is that the market has already done pricing in the damage of the second wave as well. All the NPA and the pressure concerns seem to be already behind us. Case in point being what we saw from Bajaj Finance, for instance, and how the markets reacted to the numbers.
So, well, on an aggregate basis, I think we have a reasonably positive stance towards banks, especially since the start of this calendar year, and particularly after what we saw in the prior 2 quarters of the last calendar year, in the last 2 quarters of the last calendar year, where we got a reasonable amount of comfort in terms of the way they had managed the first wave. And I think, so right now, of course, this quarter's results are kind of decent, I would say, a little mixed in terms of the overall asset quality related outcomes, although relatively smooth in terms of operating income and the way they have been able to conduct themselves in terms of operating income. We are at a stage where this quarter probably may not be the best quarter in terms of explanation regarding banks, given that we've gone through the second wave as well. but outcomes are kind of reasonably controlled nonetheless. I mean, they are slightly on the higher side in some cases, reasonably well managed in some others. But in general, so the exciting part of about financials is that even if we were to probably have a little bit of slightly adverse asset quality outcomes for a while, given that there will be some of the residual elements of the pandemic on the second lockdown, etc., which will keep which may linger. But the good part here is that valuations are not of the level where that will become where it that doesn't come in the way as much. So to that extent, we are in a relatively more secure position. We can hold it out for a couple of quarters, even if we were to probably see a little more sluggishness in terms of stock performance. So I think that's the approach that we are taking. We need to take a slightly more FY23 based and onwards kind of outlook as far as banks is concerned. With regard to earnings, we feel that this is a sector which can probably have better earnings CAGR over the next 2-3 years, especially if we start seeing some better trends around credit growth in the system, which today is not virtually not there. So I think that's the comfort that we live with. That even if we were to see a little more sluggishness or a little more kinky kind of behavior as far as asset quality related outcomes are concerned, in case of banks, we still should be okay because valuations are not kind of coming in the way. So we are reasonably constructive, at least from a couple of years perspective, as far as the banking sector is concerned.
Right.